So here comes the value investing. So what is value investing? And I will explain what is value investing, but first of all, read the definition first. So value investing is actually a very broad topic, but let me just tell you what exactly it is so that you can get an idea of that. And at least you should begin to know all this stuff so that it doesn't seems like complex to you. Now, value investing has been viewed differently by different persons. And what I mean by that is, the concept of value investing was first taught by Benjamin Graham in 1928. And there's a famous book called The Security Analysis about that, which was published in 1934. So value investing is very old form of investing, and it has been through various modifications. So what value investing was considered in 1928 is not the same what it is considered in 2015 or 16. But in a nutshell, what hasn't changed is the essence of value investing, or what it aims to propose or teach. And basically value investing is nothing but choosing a security or buying it less than its intrinsic value. Now value investing basically states that securities or stocks are always undervalued and overvalued at some point or the other. So value investing states that you gotta know what the intrinsic value of the company is. And then if the share price is trading below the intrinsic value of the stock, then you should at least buy it and hold till the share price equals the intrinsic value of a stock. And now you must be thinking that value investing is kind of similar to fundamental analysis. And well, actually value investing and growth investing are different approaches to view a stock or investing styles. While fundamental analysis is analyzing a stock from a given data. So psychology always changes in different investing styles, but type of analysis basically remains the same. And that's what basically value investing is. That is finding intrinsic value and buying the stock cheap. So now let me talk a bit about the principles of value investing. Actually, you can take a look at them and I will explain each one of it one by one in some details. So the first one is stocks have intrinsic value. So value investing is based on this very concept that every company has a certain value. So just like you buy a car, they have a certain value, and similarly like televisions, microwave, air conditioners or any other product, they have a certain value. They provide a certain benefit. So they have some sort of intrinsic value. And similarly, when you buy a whole company which produces goods and services also have a value. Now in stock market, you don't usually buy a whole company. Instead you buy a few stocks. But that doesn't mean those shares don't have a value. After all, they represent a portion of a company, and company has a value. So basically every stock has a certain value, which in value investing is called intrinsic value. And that's the very first principle of value investing. Now coming to the second one, that is margin of safety. So margin of safety means that you buy a stock significantly lower than the market price of that stock, which will reduce the risk of losing money to a great extent. Now this is an advantage of value investing in comparison to growth investing, because in growth investing people don't focus much on the price that they are paying, because they care for the quality, that is the growth of the company, and they are ready to pay a higher price for that. But if the growth doesn't matches to the expectation, then the stock price goes down crashing. While in value investing, investors look for cheap stocks, usually the beaten down stocks that are trading for less than their value. So even if the stock doesn't prove the good one or analysis proved wrong, then also these stocks are already cheap, so they fall less, and hence risk of investor gets reduced significantly. And the third is go for the long term. So this one is the obvious reason that there's no guarantee that when the share price will equal to its intrinsic value. And it may take months or even years when the value will be equal to its market price. Also, in order to make big money, you have to wait a long period of time. And there have been several instances where good stocks like Amazon and various other quality stocks have gone down around 80% or so, but they recovered afterwards, and then investors made huge profits from that stocks by just sitting tight. But if you were a trader, there is a great chance that you would have lost a lot of money. And hence, when going for the value investing way, one may better choose the long-term approach. And the last principle is think of buying stocks as buying businesses. Actually, I should have made this point at the very first, but never mind, all the points are important. So what is first or last actually doesn't matter. So think of buying stocks as buying businesses, because it changes the whole perception as to how we'll look at the stocks. Because when you buy a stock, you want to sell when the price rises. But when you buy a business, you don't actually look the same way you did when you own a single stock. So you don't just want to sell your business. So similarly, when you're buying a stock, then you're actually buying a business. Well, not a whole business, but a share that represents a specific percentage of that business. So you should always consider buying a stock as a business. Also, it will help you having a discipline a long-term investor has, or having a long-term vision, which will give you the conviction to hold stocks for the long run. And in this way, you will be following my previous point that I told you, that you should go for the long term when value investing is your choice. So these were some of the main principles of value investing and what the value investing actually mean. And if you have any doubts about that, then do post in the discussion forum and I'll get back to you as soon as possible.